Hello everyone, welcome back to my channel. Today we are going to talk about a very important and interesting topic, global mutual fund. Most Indian investors invest only in Indian mutual fund, but smart investors also invest in globally. Today I will explain why you should invest in global mutual fund and how they can help your money grow faster. I am Arif, a mutual fund distributor, and I will explain everything in very simple words with real data so that you can easily understand. So let's start. What are international mutual funds? International mutual fund invest your money outside India, such as Microsoft, Google, Meta, Amazon in US, Alibaba and Tencent in China, Siemens in Europe, and Samsung in South Korea. You don't need to open any foreign bank account. You just invest in Indian rupees and professional fund manager take care of everything. Why should you invest? Number 1, diversification. If Indian market dips due to local issue like election or inflation, global market might still grow. For example, from 1st January 2025 to 31st December 2025, many global markets gave strong return. Some Asian and emerging market perform even better than the US market. In 2025, US and S&P 500 gave around 16% return. Nasdaq Composite gave around 20% return. Now let's look at Asia. Japan's Nikkei gave around 26% return. Hong Kong Hang Seng Index gave around 27% return. China's Shanghai Composite gave around 18% return. South Korea's Kospi gave around 24% return. Taiwan Index gave around 32% return. So Taiwan, Japan and Hong Kong performed even better than the US in percentage terms. This shows Asia is becoming very powerful in global market. Now let's talk about Europe. Germany gave around 23% return. United Kingdom 21% return. France 10% return. Spain gave around 49% return. Spain IBEX 35 was one of the best performers globally in 2025. So what is the lesson? Every country grows differently. Diversification across countries reduce risk and increase opportunities. If an investor invested only in one country, he may miss big opportunity. But global diversification can improve overall return. Now we will understand three most important global stock market index in very simple way. These are number 1, MSCI Emerging Market Index. This index tracks developing countries China, India, Brazil, Taiwan. Number 2, MSCI World Index. This index tracks developed countries like the US, Japan, UK, Germany and others. Number 3, MSCI ACWI means All Country World Index. It combines both developed and emerging countries in one index. Now let's compare performance. MSCI World grew the almost around 454. MSCI ACWI is slightly lower, around 412. MSCI Emerging Market is much lower, around 196. This tells us one important things. Developed market, especially the US, performed much better than emerging market in the last 15 years. Recent year, emerging market gave around 33% return, ACWI gave around 22% return, and MSCI World Index gave around 21% return. So in some years, emerging markets can outperform strongly. Now we will understand the country and sector allocation of the MSCI Emerging Market Index in very simple language. The biggest sector in this index is information technology, around 30%. The second biggest sector is financial, 21%. Then comes consumer discretionary at around 11%. Other sectors like communication, service, materials, industrials, energy, healthcare and utilities have smaller weights. Now let's look at the country allocation on the right side. The largest country weight is China, about 26%. The second largest is Taiwan, around 21%. Then we have South Korea at about 15%, followed by Indian at around 13%. There is also some allocation to Brazil and other emerging countries. So you can clearly see Asia dominate the MSCI Emerging Market Index. Another important point is performance cycle in emerging markets usually last for many years. For example, from 2003 to 2010, emerging markets performed better than US for a long period. So if a new cycle start now, investor could see strong return for multiple years. Right now, emerging market stocks are trading at very lower price compared to developed market. For example, in 2010, emerging market stocks were about 15% cheaper than US stock based on PE ratio. But over the next 15 years, emerging market gives only 2.3% annual return, while S&P 500 gives around 13.8% annual return. So cheaper valuation does not always mean immediate high return. But things change in 2025. Emerging market becomes 40% cheaper than US stock market. Now let's understand the graph. The graph compares three regions: US green color, developed international market yellow color, emerging markets blue color, and it shows data from 2023 to 2026. Let's break it year by year. In 2023, emerging markets had negative earning growth around -15%. US and developed market were slightly positive or flat. In 2024 actual data, US about 11% growth, developed market about 1% growth, emerging market about 10% growth. So recovery started here. In 2025, US about 30%, developed market about 11%, emerging market about 17%. Emerging market move ahead. In 2026 estimated US about 14%, developed market about 10%, emerging markets about 29%. This is the biggest jump, showing strong future expectation. Many people think AI growth is happening only in United States of America. But the truth is Asia is also playing a very big role. Let's understand this step by step. This chart compares sector allocation between emerging market, developed international market and United States. The most important observation is technology sector weight US market around 30 to 32%. Emerging market also around 30%, which is almost similar to US market. That is a very important insight that many investors don't know. So AI is not only American story, it is also Asian story. Now let's understand the graph in simple words. This graph shows how much different countries contribute to global manufacturing over time. The countries including are China, United States, Japan, Germany. From 1995 to 2025, China's manufacturing share increased dramatically. Around 1995, China's share was below 10%, but by 2025, it reached around 30% of global manufacturing. This means almost one-third of the world's goods are produced in China. At the same time, the United States share slowly declined. Japan's shares also decreased over time. Germany remained relatively stable but smaller compared to China. When you invest international mutual fund, you earn return from two sources. Number one, market growth means when share price increase, your investment also increase. And number two, currency benefit. Let's understand this with a very simple example. Suppose in 2010, $1 equals to 45 rupees. You invested $1,000 in US assets. So your investment value in rupees was 1000 into 45 equals to 45,000 rupees. Now in 2026, $1 equals to 90 rupees. You still have the same $1,000, but now when you convert it into rupees, 1000 into 90 equals to 90,000. See what happened? You do nothing. Your dollar amount still the same, $1,000. But because the rupee became weaker and the dollar became stronger, your investment value double in rupee term from 45,000 to 90,000. This means without any market returns, your money doubled because of currency exchange. That is the power of currency benefit. Historically, the Indian rupee weakens by around 2 to 3% every year against the US dollar. So, international investor gets normal market return plus 2 to 3% extra return every year due to currency benefit. So the smart way to invest is not choosing only one country but diversifying globally. International mutual fund help you to earn from global growth, which can improve your long-term wealth. In the next part of this video, I will talk about some of the best international mutual fund you can consider for investment. So make sure you watch the next part.